Okay, thank you. So first of all, thank you to the organizers for having me. It's a great pleasure to present my paper, Engineering Lemons. And I study how banks engineer innovative securities that are not intended to deliver positive returns on average to their adopters. So the market I'm studying is the market for yield enhancement products. And there are three reasons why I believe the market is interesting and important to study. First of all, the securities are very complex. And what makes them particularly opaque is the fact that the fee the investor pays for the security is in most cases hidden. So it is embedded in the payoff formula. It needs to be estimated using option pricing techniques. And in most cases, the issuer doesn't disclose what is the fair value of the security, so the investor doesn't observe it. The attractive feature of the security is the high yield they offer. So on average, 13% in my sample period. And these high yields come compensated with a high downside risk. The securities became popular after the fall of interest rates to near zero. So only in the US, the annual sales exceeded $20 billion. And this is also one of the reasons why the market has attracted a lot of attention from the regulators. So for years, both the SEC and FINRA have been warning that the securities could be misleadingly marketed as conservative fixed income investments. And then more recently, we actually have a number of enforcement actions for mis-selling. So we know that there were thousands of investors, mainly inexperienced conservative investors who were mis-sold the products. Now, despite the attention the market has attracted both from the investors and the regulators, we know surprisingly little from the academic literature. So we have one case study. I'm not going to say it's seminal, but it's a very important case study. So we know that sometimes the products can be very expensive. More recently, we have suggestive evidence from Europe that on the role of complexity in the security design, and then we have a very fresh forthcoming paper in JF on the role of conflicted advice. Now, we still do not know what is the performance of the securities. So this would be kind of the first question as a financial economist you would ask, how do the securities actually, what are the returns? In this market, it's much easier to measure the complexity than to measure the returns. And this is what I do in this paper. So I quantify the fees. From the fees, I calculate what would be the expected returns of the securities, and then I also look at what are the realized securities. And I show that in this market, the returns are actually of a first-order importance because both ex ante and ex post, the returns are on average negative. So to give you the numbers, on average, the embedded fees are 7% per year. This means that under a set of reasonable assumptions on the equity risk premia, the expected return of the securities is negative. This is also what I find exposed. So on average, investors lost 4.6% on each invested dollar. These losses are not confined just to the financial crisis. And on abnormal terms, the abnormal returns are negative 7%, so comparable to the ex ante fees the securities charge. And what is also important is that those results persist over a decade which I study. So my sample covers the period from 2006 to 2015, which includes a regulatory change by the SEC when in 2012 they required the issuers to disclose what is the fair value of the security with the intention that investors may understand what are the fees of the products. I show that even after that, even after the disclosure change, the fees are large enough that the expected returns are on average negative.
But can I just pose a question? So you know that when you buy a lottery, the expected return is negative as well?
Mm-hmm.
So what's the problem?
Well, so first of all, these securities do not appear like lotteries, so the skewness is exact opposite. So they have a large probability of a small positive return and a small probability of a huge loss. They are unlikely used for hedging. And the most, in my view, the most plausible explanation of the results is that investors actually do not understand the fees they are paying. So I'm not sure do people understand if they are buying lotteries that this is a negative sum game, but in this case, there are actually a lot of investors, retired investors, who maybe didn't understand how bad product this is. So I guess broadly, I would say it's a financial innovation that has negative social welfare implications. So from that perspective, I think it's important, in my view. So I would say, obviously, these results are important for this market, but I think more broadly, they challenge the sort of traditional paradigm, the Merton-Miller view that financial innovation adds value because people wouldn't adapt innovation if it didn't add value to them. I think in this market, this evidence is more consistent with the rent-seeking view, And I think it has negative implications for the social welfare.
Well, we know that active management after fees on average have a lower return than index investing, and still we allow for it.
Yeah, the difference with active management is that you may still realize positive returns. So in this case...
Well, you could still. I mean, 10 years is probably not enough to outrule that you couldn't.
So that's what I quantify. I quantify that even ex ante, but you wouldn't expect. If you have reasonable assumptions on the equity risk premia...
Yeah, but ex ante active management doesn't have a positive expected return either.
So if the equity risk premia is, let's say, 5%, and you pay 2% for active management, you still have 3% positive plus risk-free rate.
Would have had 5%, so it's negative compared to...
So that's abnormal. So you speak about abnormal returns. I say that this is like, these are just like the raw returns are negative. This is much more extreme than active management.
Sure.
So in active management, you have risk-free rate plus maybe 3, right? In this case, it's really negative.
So the key point is really that you assume that no one understands the risk. Because otherwise, we do allow people to take risk even if the expected return is worse.
So I didn't say anything about would I allow people to buy that, right? So I didn't make any statement about policy implication.
Can I ask what the question is again?
The question is, it's a performance paper, so I quantify the fees, expected returns, ex post returns. It's a performance paper. So I quantify what is the performance. We didn't know that before. As financial economists, this is kind of very common question to kind of study what are the returns of different, innovations, asset classes, mutual funds. So as said, looking at the results from the perspective of the literature on cost of financial intermediation, I do agree we know that retail financial markets are not particularly cheap. We know they are not becoming cheaper, but I think it's still quite rare to find a market that is economically important in which the fees exceed the expected gross returns on a raw basis, not on abnormal basis. I do not know of many markets.
Care about risk-adjusted returns?
Yeah, so I also quantify the risk-adjusted returns.
Because when you say gross returns, you talk about absolute returns.
So I quantify both.
Okay.
From the perspective, from the angle of regulation of consumer financial products, we learned that even in this market, disclosure may not be enough to drive the bad products out of the market. And finally, my results contribute to the recently growing literature on reaching for yield. So these securities are designed to offer high yields at times when safer securities do not offer high yields. So I'm going to spend the bulk of this talk on explaining the empirical results, but before that, let me just give you a brief background on the market. So as said, the sales grew particularly after the fall of interest rates to near zero. So between 2006 and 2010, the annual sales in the US grew from less than 5 billion to more than 20 billion. This made yield enhancement products the largest and the fastest growing category of retail structured products in the US. So retail structured products, that's a broader category of securities, which is actually fairly economically important. So globally, between 2002 and 2015, I observed sales exceeding $5 trillion. Historically, those markets used to be more important in Europe, and more recently they are growing in Asia. But in absolute terms, the market in the US would still be one of the largest in the world. So what is unique to yield enhancement products is the limited upside they offer, so the headline rate, the coupon they promise. This is going to be on average 13%, at times when the risk-free rate would be just slightly above 1%. And the way this is structured is by including a short position in a put option, typically an exotic put option, like in this case, knock-in barrier put option, which compensates for the high yields.
Can you just put your microphone a little bit higher because your name tag is not. Thank you very much.
Okay, hopefully this is better. So the securities are marketed under different names, but they are probably best known as reverse convertibles. And more recently, securities that can terminate early, often as early as after 3 months, are becoming more common. These are called auto-callables. What is nice about the market in the US is that as long as the security is sold to non-accredited investors, it has to be registered with the SEC. So we have all the disclosure on the complex terms of the securities available in EDGAR, and this is also where my data provider collects all the terms of the securities. So I use data from the most comprehensive commercial provider that collects data on retail structured products issued globally. I validate the coverage with Edgar and Bloomberg. And the first thing I need to do is, because of the large heterogeneity in the terms of the securities, the terms are recorded in a semi-structured textual description. So I first need to text mine the terms. I need to translate the textual description into a formula, the payoff formula, which I can then evaluate and price. So to give you a flavor of the data, this is what is my raw data. So I have a textual description which describes all the intermediate cash flows as well as the cash flow at maturity. And I translate this text into math, into a formula that precisely defines all the payoffs of the security.
So, excuse me. Yeah, I just had a question. Do you have any like a sales material? What is the pitch of this product? How do they sell it? Is it like, I'm gonna get 30%?
So
out of 10 times?
So I observe whatever they disclose, whatever they file with Edgar, which is not necessarily the marketing material. We know anecdotally that these securities are sold during these free lunch seminars that are offered in some upscale restaurants to pensioners in the US, to teach them about how to manage financial matters, and we do not know what kind of marketing materials they use there. So we do not know, we know very little about the distribution and the marketing materials. We know from whatever they disclose in Edgar that they used to have very saliently advertised the coupon rate. So that used to be even in the name of the securities. But I think eventually someone told them not to do it because they stopped doing that. So it used to be that they advertised them as like 15% per year security. So these are going to be investment banks. Many of them are European banks active in the US.
Do you typically use a shell corporation as an underwriter or the main headquarter bank?
I do not know statistics on that, so I do not know. Where are you heading with that question?
Some of my friends in Russia have been sold products like that, advertised as guaranteed return, underwritten by shell corporations that went bankrupt.
Yes, so in this market, actually, the bankruptcy, it's not a big problem. So except for Lehman Brothers, we actually do not observe that the issuers, so the issuers are usually very liquid. So Lehman Brothers would be one of them that, didn't. 7% per year. So half of that, around 45%, is the commission, is the kickback to the brokers who are distributing the securities. So that's one explanation. Second explanation why they're so high, because they have very short maturities. So to the extent that the issuer margin and the commission has a fixed component, that you cannot issue, that banks do not issue anything, they would make at least 1% per issuance. Given that a lot of these products have a maturity of 3 months, this becomes very expensive on annual terms. That's one of the reasons. Another may be that it's hard for the investors to understand the fee.
So is there a declining trend in the sales of this kind of product? If you see some of the lawsuits where investors claim that they didn't understand the risk, I mean, in more recent years, you've seen more investors winning these lawsuits.
Yeah, so
I think that
we do see a huge decline in Europe, but we do not observe a decline in the US. So in Europe, probably both because of the reputation and also because of new regulation, like some countries totally banned those securities, we see a huge drop in Europe, not in the US.
So these are sold to retail investors?
Yes, this is just households. Yeah, so I do not have data on institutions, private placements. So there is some estimate that like 99% of the investors in these securities in the US are retail investors. So the translation algorithm from the texture description to the mathematical formula covers more than 85% of the potential market, or more than 21,000 securities in my sample. It covers the period from January 2006 to October 2015. And because I need data on implied volatilities, I restrict the sample to securities linked to single stocks or indices, covered in Option Metrics US. So I don't know at all how am I doing with time because of these questions, but I'm not going to spend much. I'm not going to spend much time on the pricing model. All the details are in the paper, but to give you a brief idea, because of the benchmarking, I need to estimate the value of the security on daily level. This means that I have more than 3.5 million product day observations. So my baseline pricing model is fairly simple. I ignore the volatility skew, and I calculate the value of the security using closed form formulas. So I calculate the value of the bond component, the fixed income component, Then I calculate the value of the option, the exotic option embedded in the payoff, and then I take as the fair value the sum of those components. And then to make sure that this ignorance of volatility skew doesn't drive my results, I'll also estimate the value of the security on the issuance date, and I verify that my results are not biased upwards. And the valuation inputs are standard, so probably the most important input, the volatility, comes from binarily interpolating between 4 options with the nearest strike price and the nearest maturity date. So before I show you the results, I want to make 2 remarks about the summary statistics. One I already mentioned briefly, so that's the maturity of the securities, which explains why they are so expensive. So even if I ignore the fact that many of the securities can terminate early because they knock out, if I just take the maximum possible maturity, this is on average 8 months, a bit over 8 months, and around 25% of the securities have a maturity of only 3 months. So then this fixed component of the commission and the issuer markups makes the securities very expensive on annual level. The second comment I want to make is about the riskiness of the underlying. So the implied volatility of the underlying stock is more than 45%. Or in another terms, if you look at the beta of the underlying, this is 1.6 on average. So this is a value common for the top 1 or 2 deciles of crisp stocks. And this high volatility of the underlying increases the probability that the stock drops below the protective barrier and the investor is going to participate in the downside. So this increases the probability that you will lose money with the securities, the fact that they are highly volatile underlyings. So my first variable of interest is the estimated margin. So this is the difference between the price the investor pays and the fair value of the security. This is what I call the issuer margin, and this is on average 4%. So given the short maturities of the securities, this translates into monthly fee using risk-neutral probability of early termination of 60 basis points. So in annual terms, this would be more than 7%. So to put this number into perspective, on annual basis, yield enhancement products would be 3 to 4 times as expensive as the most expensive categories of mutual funds in the US. To give you an intuition how this translates into negative expected returns, even ex ante. So here I'm showing a very simple sort of back of the envelope MBA estimate of what you would expect to be the gross return of the security. So I take a single factor model. I assume 6% equity risk premia, which is very generous. So if I assumed lower equity risk premia, the results would be even worse. I multiplied by beta of the security at issuance, and I get estimated gross return approximately 3.4%. So this is less than what is the margin on average of the securities. So this is also what you see here in the histograms. So the gross returns before fees are positive. They have to be kind of by construction as long as beta is positive. Once you deduct the fee, 60 to 75% of the securities move to the negative territory. And these numbers depend on what do you assume about the equity risk premia and the factor structure of the underlying.
So why do you do a single factor only?
Sorry?
Isn't that a single factor?
Yeah, so I do single factor. I also do in the paper 5 factor, I believe. I do the expected return on the stock market from Jan Martin's paper. So I do, many versions. In all of them, it's going to be negative. I'm sorry for the microphone, but I don't know what to do. No? Okay. So I'm going to continue all these. All these estimated expected return, of course, boils down to the assumptions on the equity risk premia or the factors. Ultimately, maybe the most convincing evidence on the performance of the securities is going to be the performance exposed, right, the realized returns. Now, quantifying this is not very simple either. So the securities are not listed, so we do not have time series data on their returns. We have only sparsely available data on the returns at maturity. So what I do is I take my translated payoff formulas, I substitute the price of the underlying at maturity, and I calculate what is the realized return at maturity of the securities. I'm going to first show you the performance of the securities with the shortest maturity because they perform the worst. So I have a selection here, but I think this sort of demonstrates what is happening in the market. So here I'm plotting average returns for the vintage of the securities issued in a given year. So here would be average return of all the securities with the maturity of 2 to 4 months issued in the year 2008. So you can see that in the crisis, the returns were the worst. But what is more interesting is that in 8 out of the 10 years, the average returns are negative for those securities. It gets a bit better. So hard to believe, right?
Well, Henk Bessenbinder has this paper where he shows that 94% of stocks underperform the treasuries. So it's really a few. So equal weighted, you're going to see a pattern where the majority underperforms.
Yeah, I discussed that in my paper, actually, that one reason for this underperformance may be this. Yet, even if I sales weight, I get the same result. And also maybe, so what is relevant here, that these securities are issued as standalone. So they are sort of not intended to be held in diversified portfolios. They are intended to be held as one security. There's a good reason why the underlying is a single stock, which typically underperforms, and not an index, because the stock is going to have higher volatility, it's going to support the high coupons. So I think it's by design in this market. I agree it's not surprising, maybe. But if there were not the fees, then the performance would be much better. So I still believe that the biggest driver of the bad performance is because of the fees. So the results get slightly better if I average over all the maturities, but still in 5 out of the 10 years, the average return is negative. Also, what I show is that if investors invested in the market, which are going to be the gray dots here over the same period, they would in all the years get better results. Now, obviously, the market is not going to be the right benchmark in this context because the securities have non-linear payoff. So next, I'm gonna show you. I'm gonna design benchmark returns for those securities. So because of the non-linear payoffs, I'm designing my benchmark as the return from a delta equivalent daily adjusted strategy in the underlying asset and the risk-free rate. So I calculate the delta daily, and then I sort of delta hedge the exposure. And the cumulative return from this strategy at maturity is going to be my benchmark return. So on abnormal basis, the difference between the product return and the benchmark return is, again, around negative 60 bips, or in annual terms, around negative 7%. So comparable to the fees charged ex ante. Okay, so I already talked a bit about what makes the product so expensive. Still to maybe stress one point. So the securities were, so the most important feature maybe in the market is the distribution channel. So they're distributed through conflicted brokers who get kickbacks for selling the securities. So I quantify that those kickbacks account for 45% of the embedded fees. So one reason why they are so expensive is that you need to pay the broker to sell the security to the investors. This is the result about the difference between the fees before and after the regulatory change. So I see a slight drop. I'm not sure, can you see the confidence bonds here? Probably not, but that drop is not statistically significant, and I also would be very careful in interpreting it causally. So the confidence bound is like somewhere here. Sorry, so anyway, it is not statistically significant. Why I don't want to interpret it causally is that around the same time there was a big drop in volatility in the market, so it could also be that the result is driven by something else. One last remark I want to make about the results. So I argue in the paper that it's hard to explain the demand for the securities with hedging motives. So first of all, the securities do not look like hedging instruments the way they are designed. So they correlate positively with the market. Most likely they correlate positively with the consumption. So it is obvious why investors use it for hedging. Even if they used it for hedging some exotic background risk, it is not obvious what kind of investors would be sophisticated enough to understand how to hedge those exotic exposures using yield enhancement products, and at the same time wouldn't understand that you can do it much cheaper using exchange traded options. So it is unlikely to explain this with hedging. Also from some surveys of the investors, when they actually ask investors, why do you buy this? They almost never say that this is for hedging. They all say it's for investment, so to generate positive returns. Then what could explain the demand for the security? So this is something on my follow-up work. This is not part of this paper. But what you see in the market, if you start to study why do we have all those exotics embedded in the products, they sort of work in the same way as add-on pricing. So I showed that by adding the exotics, the issuers can make the headline rates, the coupon rates, and the downside barrier protection more attractive. So those rates are much more attractive than what you would get with vanilla securities. If you look at the sales, you find that sales are positively correlated with those quoted trades, the most salient features, the coupon rate and the downside barrier. But if you try to look at, is the demand actually elastic with respect to the fee or the intrinsic quality of the security, the way I measure this, I look at plausibly exogenous variation in the fees that comes from market movements during the offering period. So those market movements are plausibly exogenous to the supply decision. They're plausibly exogenous to the quoted rates. They also strongly predict the abnormal returns, but you do not see any correlation with the sales volumes. So I interpret those results as consistent with the bounded rationality explanation, where banks use those exotics or add-on attributes to improve the salient quoted rates, but show the low quality of the security. So I'm going to conclude. I studied the performance of the market for yield enhancement products. I find that the fees are so high that both ex ante and ex post the securities lose money on average. Thank you.
Thank you. We have 5 minutes for questions.
Yes.
Okay.
So the title. So I guess I have a question about the title, because the title could go in many different, or could be interpreted in many different ways, right?
Yes.
Because I mean, one could think about, like, is there a social welfare story here, right? But it doesn't seem like you're getting at that. So could you just explain what exactly you're were thinking about when you chose that title, other than it's punchy?
I think I was thinking that one. But so I think engineering fits here, that it is about engineering, financial securities, and lemons because of the information asymmetry about the fees.
But you don't have like a bigger point to sort of, yeah, I mean, yeah. There's no variation in the engineering, right? It's one particular product, so one
Yes.
doesn't see like different types of products, and then one could compare the engineering, whether the more engineered products have a different effect than the less engineered products or anything like that, right? So there's no variation in engineering. So I guess it's just a
So
description
I
of
don't
the
think,
product.
so the title doesn't say the cross-section of engineering, right? It just says like, it is on engineering bad securities, whose intrinsic quality may be hard to observe.
Maybe it should be engineered lemons.
Okay, point well taken, yeah, okay.
Other questions? Okay, thank you very much.